Yes, it does occasionally happen that a covered call or diagonal position goes against us. Our hedge strategies do give us more protection than owning the underlying stock outright, and that is because we were afforded some downside protection from our collecting money from the option we sold. But what if a position goes more seriously against us? There are 5 possible actions that you can take to address the situation. But before you can decide which of these actions best suits your situation, we recommend that you ask yourself 3 questions. The first is, why is this position going against me? If you entered the position when the stock was a bit extended, or the stock is just being hurt by overall market weakness, you may steer one course of action. If, on the other hand, there is some fundamentally very negative news on the stock, you may elect a different course of action. One way to focus your thinking is to ask a second question, and that is, how do I feel about the underlying stock or ETF now? Is it at a price where I would be eager to own it if I were not already in it? Or has my opinion on the underlying stock changed and is negative now? Answering these 2 questions honestly as you can prepares you to answer the third question. What is my objective now that the position has gone against me? Your new goal can be to minimize losses, to break even, or to still shoot for profits. Do recall that Wall Street saying, hope is not traded on any exchange. Once you've decided on which of these 3 follow-up actions you want to take, let's talk about how we develop an action plan to implement our new goal. If your goal is to minimize your losses, you may want to enter a good till cancel order at a slightly more favorable price than the current price. When a stock gets hit hard, it often will bounce a little in the ensuing days, and you may thus minimize your loss by showing a little patience. The second action you can take is to buy back the call you had sold and wait for a bounce before writing, that is, selling, a new call option. When a call is nearly worthless, it is no longer buying you any downside protection or providing you any further income. So, if you buy the option back for next to nothing, then if the stock bounces, you will have the opportunity to sell a new call, achieving new downside protection and income. If you are facile in doing this, you may turn a loser into a winner. We will demonstrate that shortly. The third action you can take is to roll out your trade. This means that you buy back the option that you sold and sell an option with the same strike price, expiring in a later month. The fourth action you can take is to roll down or to roll out and down. This means that you will buy back the option you previously sold and sell a new option at a lower strike price that most often also has an expiration date that's further out in time than the initial option that you sold. The guiding principle in buying back your previous option and selling a new one is that you don't want to lock in a loss. This won't happen if you sell a new call at the same strike price, but it can happen if you sell a new option with a lower strike, particularly if the strike is considerably lower. We provide numerous case studies in managing trades in our member-only workshops. Let's turn now to a case study where we put these guidelines into practice. This is a diagonal trade on the Russell 1000 Value ETF. We see that in mid-October 2015, we entered a diagonal trade consisting of buying a May 2016 call with an 88 strike and selling a December 2015 option with a 100 strike. We spent $11.50 to purchase this option, and we would realize our maximum profit if the ETF stays above 100, the magic green line, which is the strike price of the option we sold. As you can easily see from the graph, this ETF ran into some trouble after we bought it. So, what was the thought process of the investor when the ETF started to weaken? Let's look at his answers to the questions we raised earlier. "Why is this position going against me?" And he answered that it's just been hurt by the overall market weakness, but the ETF itself is showing some relative strength. The second question, "How do I feel about this ETF now?" "If I weren't in the position already, I'd want to buy at this lower price," was his answer. And finally, what was his objective now that the position had moved against him? Well, he remained confident and still believed that this could be a profitable position. So based on the answer to the 3 questions, his new goal was to still shoot for profits or at least break even. In translating his goal of still making a profit, he employed all of these approaches, as we will see as we go along for the ride in this trade. We see his original trade and the line above which he will make his max profit. And we see that he has until May of 2016 to make the trade work, 7 months from when he entered. Since the ETF was not above 100, that option expired worthless, and he got to keep the $1.75 in premium from the first option he sold. A short while later, when the ETF bounced a bit, he sold the February option with the same 100 strike price, collecting $1.10. This brought the net cost of his trade down to $10.40 by subtracting the $1.10 from the $11.50 that he paid initially. The February option also expired worthless. Note how he waited until the ETF had rallied quite a bit before selling another option. But since the ETF still hadn't entirely recovered, and the expiration date of the diagonal was not far off, he decided to roll down, selling an April 99 option. Why did he sell an option with a 99 strike instead of one with a 100 strike? Since he only got 65 cents for selling the April 99 call option, selling an option with a 100 strike would not have collected enough premium to be worth it. So, how did the trade work out? When he closed the position, the ETF was right around the same price as when he entered, but by his management of the trade, he made a 22% annualized return on this challenging situation. When a trade goes against you, it rarely takes this sort of management to recover. But we elected to show a trade that covered almost all of the actions that you can take to recover on a trade that doesn't go your way. Our analysts take care of this for our portfolio subscribers, and for our self-directed Trade Idea Generator subscribers, we teach you how to do this in our workshops, our blogs, and we share success stories from our subscriber community.